Hey guys, Doug the Retirement Guy here. We got another review of the NEOS monthly paying dividend ETFs. There's 11 different funds. We bought them all back in May of 20th, and we want to see how well we're doing. And we want to update it so you guys can see how well it's doing for you. Before we get into this, I got to say thank you to all of our Patreon supporters. Without that, you guys, this channel would not be existing. And for everyone who has hit that subscribe button, we appreciate all of you as well. But if you can support the channel, go in the description, see that Patreon button, click on that button. You can sign up for a free membership. You can make a one-time donation, or you can make a regular monthly donation. There's a lot more information that we have over on that side. But before we get into this, let's get into the NEOS monthly paying dividend review. And before we get into review, we have to give you some legal information, and that is that past performances do not guarantee future results. The information provided in this video is for educational and informational purposes only. It is not considered financial or investment advice. The examples and suggestions discussed are illustrative and may not be suitable for individual situations. Always consult a licensed financial advisor or professional before making any financial decisions. So first off, who is NEOS? And it's the next evaluation option strategies, which is NEOS. They bring generating income generation, low volatility, and tax efficient ways of planning trading options. They do pay monthly dividends, which is what we're dealing with here, which allows you to either A, like we love here on the channel, is to take regular cash flows and pay our bills monthly, or you can take it and reinvest it, which a lot of people call dripping, or reinvesting your dividends back into the NEOS stocks. The purchase update. The question is this a good investment or a bad investment? And so far, we're going to give you guys a rating that we are doing very, very well with this. We bought all the funds on May 20th, so we can go ahead and move forward with that. We invested $1,000 per fund, or $11,000 total. And of course, again, they're paying monthly. Now, the one thing we also added to this is we did a Doug's pick. And a Doug's pick basically picked 5 dividend stocks and put them forward and said, this is what I would choose as we went through it. And we'll recover how well we're doing there. So first one we're going to talk to is SPYI, the NEOS S&P 500 High Income ETF. Now, I know this one's been very popular on the channel, and you can see back in did everything great until the April tariff situation. It's come out of that very well and pretty much come right back to where it was before. 5-day, they have a 0.04% gain. 1 month, they're up 2.4%. Year to date, they're only down 0.1%, and 1 year they're down a half a percentage point. So realistically, as I said, SPY has recovered from the tariffs situation. They've got back to where they were almost literally a year ago and running along fairly smoothly. The S&P chart was the dividends, and we'll see that they did very well, except just 2 months ago, just before we bought into this, they had a huge drop off in their dividend. And when I say huge, you got to remember this chart is very sensitive. That 5 cents we'll call is huge. They had a slight drop off of that. But on a regular consistency, they pay a very, very strong dividend. Their dividend is 12.11% annually and $6.15 cash-wise. Their current price is $50.72. I believe SPY is a very strong program. It's a safe place to put your money, and you can see that recovered in down times. It will get right back up to where it should be and be floating in equally. So very, very strong piece to have in any portfolio. Our next one is going to be QQQI, which is the NASDAQ 100 high income. And again, this one you see is almost literally done the same thing, which is what we like about the NEOS product so far, is it had a big drop off in the April, and it recovered over time. Now, in the past 5 days, it's down 0.08, which we really don't throw much concern into that right now. But you look at the 1 month, they're up 2.59, year to date 0.17, and 1 year they're down basically 1 percentage point. Their dividends, again, we take a look at this. Remember, when I say rocket, we're talking about a 7-cent gain from month to month. and they did a very good job in their dividends in the past 2 months. So this one has a dividend rate of 14.02%, an annual return of $7.33, and the current price of the stock is $52.27. So the SPI and the QQQI both are running about equal with each other, but with a 2% dividend difference between the two. And stock price is about the same. So very, very strong funds. You're going to see these things hold fairly well throughout the period of time. Another safety one to be playing in. So right now we'll cover the IWMI, which is the NEOS Russell 2000 high income. Again, they cover all three bases with the S&P, the NASDAQ, and now the Russell. And they're all performing virtually almost identical, except the Russell has a little more room that it's got to gain. It's recovering, doing fairly decent, 0.76% in 5 days, 2.13% in 1 month. It's down 5.22% and down 7.46% for the year. So this is a fund that you can already see as it's recovering. It's still got time to recover. Could possibly be a time to get involved into this one. Dividend, very strong dividend and very well balanced dividend across the board. This one pays a 15.34% dividend with an annual 7.12%, or excuse me, $7.12 annually return. Now the price, nice thing about this, is down $46.41 compared to the other funds. So a very good quality fund to watch out with NEOS is all three of these. The next we're going into is a QQQH, which is a NEOS NASDAQ 100 hedge equity income. And I know we're repeating the same things over and over, but since the April 2nd tariff attack, basically, that we put, every one of the funds so far have really recovered very, very well. When we look at this one, they're down only 0.04% in 5 days, but they're up 2.39 in 1 month, 1.17 year to date, and 1.83 for the year. So they've recovered all of their losses plus some gains now as we get into this, only a few months into it since April. Dividends, showing off very strong dividends again. Now this fund, remember, is only 8 months old when we're giving you these numbers. So the dividend is actually 5.83% as we sit today, with an estimated 8.7% over 12 months. So far, we've collected $3.07 in 8 months. So it really is not as big of a payer as we would like to see. We'd like to see that margin up to double, to 10% or better, but still does a very, very good job with a price point of $52.73. Now they do the same thing with the the S&P 500 called the SPYH, which is the head equity. And again, the equity program is done very well. They're up 2.53% in 1 month. Year to date, up 8.53. Now this thing is only 3 months old, so don't count the chicken yet, because a lot of these are still getting their legs. They're still trying to figure out where they should be. The dividend at 1.75, we're looking at about a 7% return rate. Hedge funds are going to be a little bit less in returns and dividends, but you can see they've recovered well, they've come back well, and they got a price tag of $52.78. So I'll put it out there. This goes on my watch list, that we put it out there to see how well it performs, what the chart's going to tell us. Is there going to be a dip into it? If there's a dip, we probably will want to buy into this, and we'll just keep an eye across the board on this fund. Now we go into BTCI, which is NEOS Bitcoin High Income ETF. Now we all know that everything with Bitcoin we love the volatility that's happening, because we make money off of volatility. The more we can have, the more we can generate. And this is what this fund is really doing. When you look at it, you're at 7.85 in just 5 days, 9.46 in 1 month, 10% in the year to date so far. And in 1 year, they've generated 29.8% return rate. Now, this fund is only 9 months old, so I put it this way, it's already at 9 months old. It's got its legs. It's starting to crawl. It's starting to tell you where we're heading to. And that is right now is this thing is really starting to produce, and it's very sensitive to what happens with Bitcoin. If it goes up, this thing is going to go up. If Bitcoin's going down, they're going to capture income. Look at the dividend though. The past dividend was like $1.40 basically. And they've had 2 dividends at those high numbers. Rest of them are coming into that $1.20 and above. So very, very strong dividend payout. With 9 months old, this thing's already paying out at 19%. Okay. An estimated in 12 months will be 25%. An annual return of $12.50. That's only in 9 months, remember. So when you start taking returns of 10, 12, 14% on the stock return, plus adding in 19% on the dividend situation, it's very pleasing that this is a 29 to 30% return on your investment. So very, very strong piece here. We're very pleased with this one. And even though it's had a big jump in the past few days, I would really wait for it to come settle back down and then look at buying it on the next dip and then getting involved into it. The IWRI, which is the real estate high income ETF. Now, real estate has not developed as strong as a lot of people were expecting. Interest rates have stayed high. The demand is out there, but the interest rates are high, and people are worried right now. They're worried about the whole economic type situation. But this fund, after the April kickback, got to the -1 percentage point year to date. Now, this fund is only 6 months old, so I always got to tell you this is, that's why the year to date and the 1 year look identical to each other, is because we're only dealing with a 6-month picture so far. But this one's pretty much been a flat program after it's recovered after the April turnaround. Dividend-wise, about 50 cents per month that they're coming in and paying off with. So it's a 5.87% in 6 months. So the computer spits out and says it's going to be about a 9% total dividend across the board. Current price of $50.30. So the NEOS product is a little bit higher per share to get involved into, but they're doing some decent numbers currently, at least getting us back out of this big drop that we had in April. Now, BNDI is EOS's Enhanced Income Aggregate Bond Fund. Now, bonds, I've always been told when the interest rates go down, bond rates will go up. And when interest rates go up, the bond rates go down. It's kind of the opposite of each other. Problem is, we've had zero of either one. The performance across the board on bonds, we have not seen much increase. We have not seen the decrease in the interest rates. So this thing has been very stable and very just floating out there. And you can see 0.03 percentage points in 5 days, 0.5% in 1 month. Basically, again, year to date, it's only up 0.5%, and 1 year it's 0.85. This one's been out there for a lot longer period, pretty much paying a fairly steady between 20 and 22 cents in dividends. So your fund is a 5.75%, which is definitely better than the money market fund that's paying, I think Fidelity I just got was a 4% money market fund, and an annual payment of $2.69 per share for a $46.87 stock. It's not bad. If the bonds take off, we'll see this thing take off. But realistically, that's the problem with the bonds, is they're just sitting tight. Now we go to the HYBI NEOS Enhanced Income Credit Selector. Now this one again is 9 months old. It's come out but did not get to its high point so far, and you'll see it's 1 year we're down 4.15%. This is, as I said, 9 months old, and we're having it's like slowly niching away at that 0.59% growth in 1 month. What year to date, it's down 1.51. So they're really watching those numbers hard. The dividend is paying 6.56% over 12 months. They're estimating to get about 8.7, 8.5 to 8.7 return on $3.30. Now lately they're starting to pay a little bit more of a dividend, up to 36 cents. getting back to what we call normal average across the board. It's a $50.42 stock. So to me is very expensive for what the return rate would be across the board. Our next fund is CHSI, which is the Enhanced Income 1 to 3 month T-bill. This is going to be just like a bond fund. There's going to be very, very little movement. You're doing this as a safety net, putting money away to hopefully collect an interest rate. You can see the numbers are not really going up or down any which way. The dividend pays a 5.39%, which is $2.68 on a $49.84 share. So just a steady, this is almost like I would put it, truthfully, I put it as just a income generating piece that you want pure safety across the board to get you 5%, and 1 to 3 month T-bills that you can see, and that's why you see I call it a razor, the saw blade tooth look of the formula is about every 3 months. They're selling off the T-bills and buying new T-bills. So just constantly, boom, buy, sell, buy, sell, buy, sell, buy, sell. And as it gets older, it gets valued, it gets up, and then they drop it off and sell it, start over. So a safety point, if you want to put money into it, that's about what those are for. And then we get into the TLTI, which is Enhanced Income 20-year Treasury bonds. And as I told you, the bonds have not done much. This one is 7 months old. And you can see in the 5-day, 1 month, have really done nothing other than it's dropping off again. Year to date, it's down 3.52, and 1 year is down 9.30. Dividend, very, very, very low at 6.53% unestimated in 12 months. It's currently selected $3.82 percentage points, and the annual's paid $1.75 or $1.73. So really not much coming out of this one, even though you're locked. Basically, they're buying a treasury bond, locking it up for 20 plus years, and they're really getting small points with it. This is just something I really am. I don't want to say I'm negative about things, but this makes no sense to me to invest in this in any way, shape, or form. I do see people saying that they have invested just for a safety measure that they can collect that hopefully 6%, which is more than they're getting in the bank. But there's a gamble to all that. There's a loss. You've lost 10%, and you're only going to get 6% back in a dividend. It's just not good for any retirement account or anything like that. So let's take a look at the portfolio. As we said originally, we invested $11,000 into the fund, $1,000 per stock or per fund across the board. And we've already in 2 months, we have generated $608 of profit, which is stock growth plus dividends for 2.87%. And we're going to look at this thing that we're probably going to generate 37% when it's all done in 12 months. Now, remember, we're dealing this in a 2 months of old of this portfolio. The dividends paid $192.29 in 2 months, or 1.75. So we're looking at about a 10% total return on dividends if everything stays, again, as planned and as things are moving forward. The stock return, the actual natural growth of it, we've gotten $488 or 4.4%, giving us a 26% return over the next 10 months. So the numbers right now in this portfolio look very strong and very easily. So now we'd like to take a look at the Doug's picks out of it. We took the 5 stocks that we would have, or funds that we would have invested into that we liked the best. We basically put $2,000 in each one of the funds, balanced out. And what we see is we're really targeting a 28% return. We've gotten 4.73 so far, $472 in total return. That makes up $139 from dividends, which, the number right now is bouncing all over the place. In 2 months, it's very hard for the computer to spit out exactly what we're going to see because of the changes in dividends. But basically, we're looking at about an 8% portfolio as we're looking at. Now, if the stock market continues to do what it's doing and recovering, that the estimated return on the value of the funds across the board is 20.02%. So We're pleased right now with what we're getting out of it. We always love to have that 8% return onto it. And we're expecting a couple of the funds that once the dividends straighten out and the funds start taking off, we're going to see these numbers probably increase. Primarily what we're trying to do is get an increase in the dividends. But overall, in my opinion, NEO stocks are doing very well. I would highly recommend that you do these top 5 and play in the market accordingly. So if you're looking for something new to add, take a serious look at this. But remember, all of this, always ask a financial advisor for any financial advice and helpful parts. Guys, it's Doug, the Retirement Guy. I hope you like what we're doing here. If you haven't already, hit that subscribe button. Leave a comment. Tell us what you like, dislike about the whole program. And if you can support the channel, we'd appreciate it. Thanks, and we'll catch you next time.